Hello and welcome to the January edition of the Pre-Sale Pulse Trending Topic. I'm Susanna Gonsalves, and today we're joined by a very special guest, owner and mortgage specialist Scott Gingles of Nest Mortgage. Now, 2022 was a year of policy shock, especially in the way of interest rates and mortgage policy. So today we asked Scott, our preeminent mortgage expert, to answer some questions and shed some insight in what we can expect in the 2023 mortgage landscape. Well, thanks for being here, Scott. I don't think in my entire career I have ever plugged the Bank of Canada's rate announcement into my calendar and committed them to memory. It was clearly the topic of 2022, and as we start 2023, how are things looking in the world of mortgages?
Well, thank you. I'm really excited to be here. As we know, we're coming off a historic year, 7 rate increases across 8 announcements. Some of my colleagues have coined the recent market activity as the Great Pause, where rates have climbed, activity has cooled, supply has increased, and yet values have not come off as expected.
Now, we've tracked these hikes closely on this channel over the past year. They've led the CPI to drop from 8.1% in July to 6.8% in November. That being said, inflation is seemingly more sticky as of late and hovers well above the 2% target.
Yeah. In addition to inflation, the Bank of Canada also looks at macro indicators such as GDP and employment. Although growth has been muted, over the break we saw some incredibly strong employment numbers that blew year-end expectations. The next meeting is on January 25th, and while some analysts are almost begging for a pause, recent reports are leading the market to expect another 25 basis point increase.
Yeah, now I know that Macklem has hinted he would rather over-tighten rather than under-tighten. Now, speaking of predictions then, what are those in your field expecting in 2023?
Yeah, normally it takes 18 to 24 months for interest rates to work their way through the economy. We're only 10 months into the rate tightening cycle.
That's depressing.
Yeah, I think it's reasonable to see a 25 basis point increase here in the near term, and the bank will take a wait and see approach as we head into the rest of the year. Looking 9 to 12 months from now, assuming inflation remains in check, some suggest we may see rate cuts to fend off recession. Normalizing rates 1 to 2% from where we are right now would be welcome news by all.
Yeah, absolutely. Now, these interest rate increases have a twofold effect of cooling the market. One in the form of increasing general uncertainty and therefore buyer uncertainty, and the other in materially impacting affordability and the ability to qualify for a mortgage. Now, do you have any sense exactly how much affordability has been impacted for the average buyer?
Yeah, it's a great question, mainly because of the mechanics of the mortgage stress test. It's not as simple as asking how much have interest rates increased to get to that number. So to give you an example, a buyer in today's market with $175,000 of household income, looking to apply about a 20% down payment, this buyer would be qualified at roughly 7.1% today and would qualify for enough mortgage to purchase a home of roughly $900,000.
Now, and what about that same buyer prior to the start of 2022? At that time, rates were, 4% or less, which seems like, a very different world than now.
Yeah, based on the lower stress test back then at 5.25%, the same buyer would have qualified for significantly more mortgage, therefore a higher purchase price. Assuming everything equal, the same buyer in early 2022 would qualify to purchase a home well over $1 million. The same buyer has experienced a roughly 15% reduction in affordability over the past year.
And seeing as prices have only dropped by, 3%, that's definitely not working in the favor of buyers. So in other words, buyers that delayed the purchasing decision in Q1 2022 to today would be limited to homes priced 15% lower than what they could have otherwise purchased. Now, homes priced at that higher end of the market will also be challenged as they see their buyer pool shrink due to this tightening in affordability.
Yes, we've seen this play out in the detached market. The highest priced product category saw the biggest contraction this last year. It's also important to note that many savvy buyers were pre-qualified early and secured pre-approvals and rate holds that are held up to 4 months. This reduced the impact of their affordability.
With that in mind, then, how should buyers be approaching mortgages currently? So, for example, how should buyers be thinking of variable versus fixed mortgages? You must get this question a lot.
Well, as bond yields have come off over the past quarter, which directly impact fixed rate pricing, fixed will outperform variable in the near term. The challenge with securing a fixed rate today is that you may be fixing at the near peak for your rate and payment. Clients have actually been opting for a flexible strategy as of late, securing either a variable rate mortgage or a shorter term, even at the cost of a higher rate, looking to reevaluate their options 12 to 18 months from now.
And so what are we seeing for rates that are just 1 to 2 years?
Traditionally, we see 1 to 2 year rates offered lower than 5-year terms. At the moment, shorter 1 to 2 year fixed rates are at par or even higher than 5-year fixed rates. What this and bond yields are telling us is that rates will remain high in the near term, and rate drops are being priced in 12 to 18 months from now.
So finishing off here then, do you have any other general advice for how to navigate the mortgage landscape in 2023?
For sure. Being prepared is always going to be the number one thing. Being informed on your options is more important than ever. For prospective buyers, I'd suggest reaching out to advisors such as those at Nest, who can help you get pre-qualified and secure a rate hold from over 200 lenders. For existing home and mortgage holders, make sure you're aware of your trigger rate and your renewal date. Regarding renewals, the spread in rates offered by competing financial institutions is greater than we've seen in a long time. Not exploring your options with your mortgage broker could prove very costly.
Yeah, I bet. Now, you mentioned trigger rates. What's the impact of these trigger rates? Why is this concerning?
Well, the trigger rate specifically pertains to a static payment variable rate mortgage, where the payment remains constant regardless of whether prime increases or decreases. Late last year, roughly 50% of all mortgages in Canada had reached their trigger rate, where the mortgage payment is no longer covering the interest owed. So with prime increasing as rapidly as it did last year, you would have had to increase your regular payment by as much as 20% to keep the amortization on track. So we don't want to be paying a mortgage indefinitely, so it's important to reach out to your broker to review your amortization and payment strategy.
Ultimately, you're just going to end up paying way more interest.
Exactly.
Yeah. All right. Well, Scott, thanks so much for joining us today for January's Pre-Sale Pulse and what is undoubtedly still the hottest topic in real estate. Now, hopefully we can check back in with you as things continue to evolve.
Well, thanks for having me. If any viewers have any questions or are looking for mortgage solutions, visit us at nestmortgage.co.
Now, we hope you, our viewers, found some value in today's episode. The MLA Advisory team is active in every major market across Canada and digging deep into some of the micro trends happening right now. It's our goal to provide our viewers with actionable intelligence and to stay real estate intelligent. Thanks for joining us, and see you next time.